Hi Earthlings, I'm Trice. Want to make a little bit of money in the stock market but don't know how? I love making money in the stock market because once you educate yourself and learn how to do it, it feels effortless. It feels like your money is just making you money while you snooze, play, and daydream. Even though the coronavirus has dropped the US stock market by over 25%, I am still over $30,000 ahead in this portfolio. I've been investing since I was 16 and I didn't really figure out a formula until I was about 29. But all those years of experience made me come up with a formula that was repeatable to produce long-term results. And I'm going to get you started with 3 basic steps. So if that sounds good to you, keep on watching. Quick disclaimer here, I am a certified financial planner, but this video is for entertainment purposes only. Please do not take it as personal financial advice. Even if this is your first video you've ever watched about investing in the stock market, you already know stuff or heard stuff through the collective consciousness. So as we're learning, we're going to be doing a little unlearning at the same time. And you'll understand what I mean as we go through this video. The first thing when people start investing in the market, they're like, when should I get in? Is there a certain time? What's the perfect timing? So I have to answer that in 2 ways. First, there is no perfect time to get in the market. There's no special day that's going to make you that $1 zillion. But if you want to become a successful investor, follow this tip and always be investing. Now, I do use timing strategies and look at overall trends. This does not help me figure out what the perfect day is, but it does give me a seed of an idea when I should make my portfolio more conservative or when I should be more aggressive and pass on that fancy new kitchen table and put that money into the market. I'm going to show you exactly what I mean on this screenshot. This is the S&P. The S&P is just a collection of large US companies. Think Apple, IBM, Amazon, stuff like that. This graph starts off July 11th, 1980. Now, what do you notice by looking at this graph? What direction is the graph going up over time? Now realize you're looking at 40 years of time, but it goes up over the long run. So one of the core principles of getting a positive return is thinking in the long run. This is not a get-rich-quick scheme. Now I'm going to zoom in a bit and show you how you can use this information to your advantage. Let's take a look at the last meltdown. 2007 was the absolute height of the market. And again, we're looking at the S&P 500, and it totally collapsed because of the 2008 housing crisis. If you guys were alive, which I'm imagining you were around that time, what was the beat on the street? What was the feeling? Crazy fear. So how can you use this to your advantage? When you feel that crazy fear on the street and the market takes that into account and drops down drastically, you'll know that it's generally somewhere next to the bottom of the market. As opposed to, for the past decade, you can see this trend line going up, 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 up. So the past couple years, I've been thinking, okay, we are somewhere near the top of the market. Now, why is it helpful to know where the bottom-ish and the top-ish of the market is? If you feel like you're kind of at the top of the market, nobody knows where the peak is, but if you feel that you're kind of at the top, then you know to make your portfolio a bit more conservative. And if you just experienced a huge 2008, you know that there's potentially more opportunity on the table and it's somewhere next to the bottom. I might think, hey, I might not take that trip to Nepal this year and I might use that money to invest because it's such a good time to buy. As opposed to a couple years ago, I was like, this party cannot go on forever. And 2 years ago, I moved about 30% of my portfolio to cash. It's a reading that you will get better at predicting. And an easy barometer to tell is if there is fear and panic on the street, usually the market is towards the lows. And if there's just wild optimism of the party going on forever, you know you're kind of towards the top and you might be overpaying for some stuff. Now that you have kind of a framework of when to get into the market, what stocks do you buy? What is the hot stock tip? Remember how I said we all learn through osmosis, through this collective consciousness, and we hear a lot about hot stocks. And I'm going to say ignore all that because it is damn hard, and statistically 1% of all investors are able to consistently pick the hot stocks. And even though I feel I'm intelligent, I don't want the pressure of having to perform at 1%. You want to make investing in the stock market easy and still get an amazing rate of return? This is how you do it. You let go of trying to ride the hot stock tips. You just let go of that. And you decide that you're going to build something that will perform no matter which company wins. So I'm going to use an illustration to make that more clear. Imagine you have one of the best, robust companies of today. Let's pick Apple stock, and that you invest all your money in that, which sounds like a great deal, right? Because they're a very good company. Everybody has, I have three iPad. I'm on an iPad. I have an iPhone. I have an iComputer. They're doing amazing. So let's use that as an example one that somebody does and puts all their money in there, or somebody else puts all their money in the S&P 500. Now, I'm not saying do either of these. It's just for this illustration. The S&P 500 is an index fund, a collection of large U.S. companies. Now, let's imagine we have Armageddon on our hands. What event do you think is more probable to occur? A single company going out of business, no matter how strong they are, or 500 ever-changing companies. So it is very hard and very low probability that all 500 of those companies are going to go bankrupt at the exact same time. So do you see how this is potentially protecting your investment from a total absolute loss? Like the probability of 500 companies going out of business at the exact same time is very low as opposed to one company going out of business. It spreads the risk. But we don't want to just be average. How can we buy low and sell high without trying to time the market? Now, how can we buy more when the market's down and buy less when the market's high without trying to time the market, without trying to think, oh, this feels like a money-making day. I think I should invest. How can we do that mathematically? There are several different timing formulas I use to do this. And the simplest and most common is dollar cost averaging. All that means is that you are putting the exact same amount of money in the market on the exact same day each month. And it will be easier to see how this naturally allows you to buy less when the market is high and more when the market is low. So let's take the S&P. And for easy math, we're going to say that the S&P is just $1 a share. It's January 1st, and we see that the S&P is $1 a share, and we decide that we are going to invest $100. So that means we buy 100 shares. A month ticks by, and it's February 1st, and the market has been raging. It has been on fire, and the S&P is now $2 a share. But we still invest our same $100. So instead of being able to get 100 shares, we now only buy 50. Do you see how we naturally buy less when the market is high, but we don't take ourselves out of the game? Now let's keep continuing down. March rolls around and the stock market has plummeted. And now the S&P is down to 50 cents a share. You diligently, knowing the essential rule of investing, which is always be investing, say, this is great. Everything is on sale. And you continue to invest your $100 and you end up picking 200 shares. Now, I don't necessarily recommend this strategy on single stocks. Let me take you through an example on Apple stock. Apple stock, let's say it's $1 a share, and you went through the whole thing. January 1st, you had 100 shares. Yay! But let's say February rolled around and the stock was cut in half. So now it was 50 cents a share. Now you have to remember, you are invested in a company. And if there isn't a worldwide pandemic, that company is usually having some kind of problem. It could just simply be a PR problem, but they could be going bankrupt. So you really, if you're going to use this strategy on single stocks, you need to do your due diligence and research the stock. research the fundamentals, which takes a lot of time and effort. And I'm too lazy to do that. So I just use that S&P index fund instead, because I know some companies will go bankrupt, but the whole index will not go bankrupt because new companies are always coming in to take its place. Now, Earthlings, there is a lot more to know, but I would really love to hear your thoughts. Was that overwhelming? Was that complicated? Was that too easy peasy? Investing is built on a whole bunch of series of principles. And to be a successful long-term investor, you ultimately need to develop an investment strategy. And that essentially means you know what to do before something happens. I knew what I was going to do before the market dropped. I knew what I was going to use the money for before I invested it. Everybody's investment philosophy will be different. Everybody has different risk tolerances, different timelines. But it doesn't have to be complicated if you're taught how to do it. So I'm curious, do you have an investment strategy? Are you interested in building your own? If you found this video helpful, will you do me a favor and sprinkle some love on that like button? And until next time, from Montana, ciao!